This is Chris Matthews with another video on Forex trading strategy. This is entitled The 5 Steps to Making Winning Trades. A lot of traders, I feel, think that if you have a good strategy, that means you have to have many steps and it has to be really complicated in order to be successful. I don't think that's the case at all. In fact, with my trading strategy, it adapts to any market environment, but it only requires 5 steps. These 5 steps are: first, to analyze the market and look at the fundamentals, and based on that, look for some kind of weakness or imbalance in the market so that you can select a directional bias. You have to get the direction right, and you also have to get the volatility right. By looking at the volatility of the market and combine that with the directional bias that you have, you can structure a trade. So structuring a trade means that you select the right type of trading vehicle and the right type of trading style for the current market environment. Then you manage risk beforehand so that when things don't go your way, when you're in a trade, you know how to react objectively and rationally. Once you've taken care of all these different things, then it's time to enter the trade and monitor it very closely. So let's go into more detail. The first step is to analyze the market. Spend most of your time researching what currencies are doing and why, by reading the news, reading bank reports, and watching videos on Bloomberg from analysts and so on. You want to identify any imbalances between the opinions of the market, those of central banks, and the economic numbers, and I'll explain this in more detail, specifically on how to spot these imbalances in an upcoming post. Your Forex trading strategy should consist of 80% analysis as you sit on the sidelines and watch the market from afar, and only 20% of your time should be actually spent on making and managing trades. Next, you need to select a bias, and this is another word for direction. If you identify an imbalance or a quote-unquote weakness in the market that can be taken advantage of, decide on the direction that the market is likely to correct in and wait for the market to start moving in that direction. Again, I intentionally kept this vague and didn't go into a lot of detail explaining how to spot and actually profit from these imbalances, but I'll have many more posts on these after this one. The next step is to structure a trade. Once the market starts moving in your direction, it's time to select the right type of Forex trading strategy. I go over 3 types of trading strategies: high volatility trades, low volatility trades, and carry trades. Each one is suitable for a different type of market environment. The volatility in the market is always changing, so if you just use one strategy all the time, eventually you're going to have some very big losing streaks because the type of trading strategy that you're using may not be suited for a different type of market environment. So I'll go over in more detail on how we select the right one for what's currently going on in the market with some very strict criteria. Manage risk beforehand. Next, managing risk involves looking at the event risk, which is the likeliness of something occurring, such as a particular outcome from the political situation that's going on in a certain country. And there's also volatility risk, and this is the likeliness that a stop will get hit if it's too close to your entry point, in which case you would lose money if that happens. And you do all this before putting on a trade so that you can make rational decisions if things don't go your way. Too many people just set a stop loss after putting on their initial trade and expect that to manage all their risk, but they don't always obey that stop loss and end up doing other things and try to get really subjective when emotions start to cloud their judgment. So managing the risk beforehand and objectively determining what you're going to do if a particular type of event happens or volatility changes in the market means that you'll be prepared for anything that happens, and that's very important. It's a skill that the best traders have. The last step is to enter the trade and monitor it very closely. So you've done all of your careful research and you've decided that this is a good opportunity to get into the trade, and now you enter, but you can't just let automatic orders do the work for you. Stay alert in case the conditions which you entered upon no longer apply, in which case you should get out. This includes things such as the market volatility having changed dramatically, sentiment reversing, or the fundamentals or the underlying economics have changed. If any of these happen, you need to get out of your trades.